The Media Institute, the foremost independent advocate for the First Amendment for over 4 decades, is one of the nation's leading nonpartisan organizations focused on media and communications policy. The Media Institute promotes freedom of speech, recognizes excellence in journalism, and encourages a competitive media environment and communications industry. Considering the current state of affairs in the nation's capital and across the country, our mission is more relevant than ever. The Media Institute is well known for our policy papers and briefings, and as the founder and coordinator of Free Speech Week. One of our signature programs is the Communications Forum Luncheon series. It brings together thought leaders from the public and private sectors, government officials, journalists, and communications executives for timely and relevant dialogues. As we gather virtually for this month's Communications Forum, the Media Institute wishes to recognize our sponsors and supporters. APTS, ACA, AT&T, Charter, CTA, CPB, Covington, Cox, CTIA, David Wright, Disney, DLA Piper, HC2, Howard Stirk, iHeart, IAB, ION, Lehrman Center, LG, NAB, NBC Universal, NCTA, NMA, Nixon Peabody, Sinclair, Tegna, T-Mobile, US Telecom, Verizon, Viacom CBS, Wiley, and Wilkinson Barker Knauer. Thank you. And now the President and CEO of the Media Institute, Rick Kapler.
Well, thank you, and good afternoon, everyone, and welcome to our first virtual communications luncheon. I wish we could all be together in person, but I'm glad we can meet here in cyberspace and still have a really interesting presentation for you. I want to begin by thanking all of our luncheon sponsors. You've been very supportive and very patient as we've waited out the pandemic this spring. I truly appreciate that. I especially want to thank John Taylor of LG Electronics and Dave Arland and his team at Arland Communications for helping us put together this virtual event. Just a brief word about next month. On Wednesday, July 29th, our speaker will be FCC Commissioner Michael O'Reilly. We're not sure yet if that will be a live event at the Willard Hotel or a virtual event or some combination. But we're determined to hear from Commissioner O'Reilly one way or another, and we'll keep you posted. Today, as we're still in the midst of this COVID-19 pandemic, we have a very timely presentation for you. Our speaker is Davis Hebert, who is a director and senior high yield analyst at Wells Fargo Securities in Charlotte, covering the media, cable, and telecommunications sectors. Davis joined the high yield research team in 2007 and is a member of the institutional investor All-America Fixed Income Research Team, most recently placing #1 in the broadcasting and publishing sector, #2 in telecom services, and #3 in cable and satellite in their 2018 survey. Before joining the group, Davis spent time in leveraged finance on loan underwriting and portfolio management functions for the media and telecom sectors, and also has commercial banking experience. Davis received a Bachelor of Science in Business Administration degree in finance from Appalachian State University and an MBA from Virginia Tech. Davis holds the Chartered Financial Analyst designation and is a member of the CFA North Carolina Society. Today, we've asked Davis to give us his insights on how the COVID-19 pandemic has affected the economics of the media and telecom industry and how different sectors have fared for better or worse. And we hope he might gaze into his crystal ball and give us his assessment of what this industry might look like in the post-pandemic world. Let me say just a word about how our question and answer session will work. You'll see on your screen a little area that says ask a question. So I invite you, as Davis is speaking, to, as questions come to mind, just use that feature to send your questions and they will come to me. I will monitor the questions coming in during the presentation and then ask selected questions of Davis at the end. So we'll have a good Q&A session, and please do use that ask a question feature. So ladies and gentlemen, it's my great pleasure to introduce one of this industry's leading financial analysts, Mr. Davis Hebert.
Thank you, Rick, for that nice introduction. I greatly appreciate the opportunity to speak with you today, share with you my latest thoughts in the industry, which seem to be changing week by week, address any questions you may have about this extremely unusual time in our lives. I dare say if I did have a crystal ball, I might not be doing this as a day job, but I will talk about some of the things we are watching this summer as clues for what this recovery may look like. So I'm going to move to the second slide and look at the agenda for my prepared remarks. First, we're going to be talking about a big picture overview on the economy. This is likely the most complicated picture we've seen in a generation. And then with the stay-at-home measures placed in March, we saw unprecedented changes in audience trends for media. So we're going to focus on that next. Then we're going to move to the shock wave we saw in the advertising world. Although one could argue people were consuming more content than ever before during the pandemic. Then we'll cover the evolution of video. This sector has been through a transformative shift the last several years, and COVID-19 accelerated many of these trends. And then finally, we'll get a bit more granular and look at how specific subsectors fared during the second quarter and provide some factors that we'll be looking at for this summer to better estimate risks in the coming months. First, on the economic backdrop. So let's look at the pre-COVID world. It seems like a lifetime ago. What was the world like 4 months ago? Well, we were in the late stages of a 10-year economic expansion. Many economies felt we were at the doorstep of a contraction, but at any rate, things were growing, albeit slowly. We had solid corporate earnings, low unemployment, and a strong spending environment. When the pandemic hit, we were in the midst of stay-at-home orders and the like, and we saw an economic hit like nothing we've seen before. Companies talked about how this was worse than 2008, 2009, given how quickly the shock happened. And then there was a complete stop in the service segment of the economy. The service segment makes up 60% of consumer spending. Unemployment spiked to levels we have not seen since the Great Depression. And the Fed acted very aggressively. They used a lot of different support mechanisms. They cut rates to near zero. They put in a corporate bond buying policy, something we've never seen before from the Fed. And as a result, a lot of economists, including our talented Wells Fargo team, see a snapback in the third quarter. Views are inconsistent. And at the end of the day, the economy will be smaller at the end of 2020 than it was at the end of 2019, perhaps by as much as 5%. There is a recovery expected into 2021. The economy will be 2.5% smaller by the end of next year, according to our economists. Now, one interesting thing is that the consumer spending on services took such a hit, they were forced to save money. And so it's an idea that can help on the other side of the coronavirus to the extent consumers can actively start spending on goods and services again when things normalize. Now, here are some graphs on slide 5 illustrating some of the points I just hit on. On the top left, you can see the sequential change quarter to quarter, and Wells Fargo expects a nice bounce back in Q3 and calmer waters ahead in 2021. If you look at the top right, unemployment in March and April soared toward 15%, and that is the highest level we've seen since the Great Depression, as I mentioned. We know this may even underrepresent the unemployed base, as it doesn't fully count furloughed employees. On the bottom left, you can see the Small Business Optimism Index. Now, small businesses were also hit very hard during the COVID-19 situation, and many of them had to close their doors. We saw a little bit of a bounce back in April, but we are seeing a multi-year low from that perspective. And then the bottom right's an interesting graph. It shows the change in retail sales month to month. And as you can see, it kind of bumped along plus or minus 1, 2, 3% for the last number of years. On the far right, we saw a 15% decline in March. In April, it came back 18%, and the market was expecting something closer to 10. So investors got very excited that we're at the other side. We are ready to put money back into risk assets. Now, as I mentioned, the Fed took extremely aggressive action to manage through this economic shock and provide a bridge to the other side of COVID-19. Some of them included unprecedented measures like buying corporate debt to supply liquidity. And as you can see, the Fed had already been lowering interest rates to match the slowing economy I discussed earlier. Now, this is the discount rate here. The rate which banks lend to each other is cut to near zero in reaction to the COVID-19 shock impact. And I think this is a really important graph to show because the next slide, slide 7, shows how the S&P has really bounced back after the COVID-19 volatility. And so the aggressive moves, along with the Fed commentary that basically they said they will do whatever it takes to foster support for the economy, has created what we've called a melt up in the markets. Investors have felt compelled to take significant risk that we will see a V-shaped snapback in the economy versus a U-shaped or an L-shaped recovery. And I think the idea that the Fed has backstopped the economy and risk assets, coupled with a world that is very cash rich from low interest rates around the world, it's created what, again, that melt up mentality in risk assets in the stock market and things like junk bonds. You can see that this in a bit more of a smaller time frame, and see how quickly the market turned. The market hit its low point, the stock market hits a low point on March 23rd, 35% off the all-time high. Now we're only 8% off that high, despite the highest unemployment in a generation and an unclear path to recovery. So clearly investors are feeling emboldened by the Fed's actions. I don't want to get too downbeat, so let's look at some audience trends, because the COVID-19 situation resulted in some very interesting factoids. And I think there are two really key things to point out on this slide. One is that we had been seeing steady leakage of audience from traditional media over to digital for the past 3 to 5 years. Now the pandemic situation really tipped this over and probably accelerated some of these trends. And second, there was a clear distinction between in-home media and out-of-home media. So with the stay-at-home orders, in-home media consumption surged. Some estimates had streaming content up 60%. People were streaming during daytime hours with working from home. Local news had ratings it had not seen in years. Now time will tell, but broadcasters are still very hopeful that at least 25% of that incremental audience will stick. Social media and gaming also showed substantial increases during the pandemic. And all that boils down to a larger use of broadband. Cable companies reported seeing a 20% tick up or more in data consumption. And that drove many people to upgrade their speeds and pick a better quality network. Now, out-of-home media consumption obviously took a big hit. Looking at audio first. Now, audio is traditionally consumed outside of the home. So think about on your AirPods between going from home to work, or going in your car somewhere. The streaming volumes were down. AM/FM listenership was down as well. Consumers even shifted to video when listening to songs. So think about listening to a YouTube video instead of listening to Spotify. Now we have seen a bit of a pickup in May for podcasting. So there are signs of light. Out-of-home advertising also suffered hugely from lower vehicle traffic, people not using public transport, or airport activity. Now it's going to be interesting to see what happens this summer when people are on the road again. No one's flying to Europe or things of that nature. So a lot of people are going to be, traveling to the Grand Canyon, for example, and using more roads, and vehicle traffic could be at an all-time high this summer. So it's certainly something we're watching. Theaters are forced to close. There are plans to reopen in July, still questions about what they're going to show. Live entertainment has come to a full stop, uncertain return. And a lot of advertisers have relied on live events to reach younger demographics. Looking at commercial data traffic, as I mentioned, residential data traffic was up 20%. Commercial data traffic was hit hard by small business declines, as well as people working from home, so they're no longer at the office. So those are just some interesting trends that we've seen in the COVID-19 world. Now, looking at slide 11, this is an interesting look at the media world before all this hit. So this, I think, shows a longer time frame in how media consumption has shifted. And as you can see, the bar on the left is much smaller than the bar on the right. And that basically means that people are spending a lot more time with media than ever before. If you count up the hours and minutes here on a daily basis, you're looking at nearly 12 hours a day. And that does include some overlap. So if you're on your phone while watching TV, it's definitely going to include that. Not surprisingly, live TV and radio are down, traditional media, not as much as you might think. Older generations still focused on those media channels. So if you look at younger demographics, I would think you would see live TV consumption far less than this graph shows. And advertisers, when you look at how much media is being consumed, they've really salivated at the opportunity to build these relationships with consumers on these digital platforms. People are seeing more advertising than ever before because of this media consumption. Now looking at slide 12, these stats are also pre-COVID, but it does give you an idea of how much opportunity there's still left in streaming video. Streaming video was only 20% based on the last Nielsen numbers of video viewership. Now post-COVID, that number is probably going to be substantially higher. And as I suggested in this post-COVID world, especially with no sports, which relies on traditional video, and streaming video in the home, it likely has accelerated this trend, perhaps permanently. You can see on the right side that Netflix is the leader, followed by YouTube, Hulu, and Amazon. Still too early to tell, but obviously you have Disney Plus, you have Peacock, you have HBO Max that are in still very early stages. So this slice of the pie for streaming is only going to get bigger. Now let's focus on the advertising side. As I said, there were some interesting dynamics with audience trends, and a lot of growth in some cases, again with in-home media. Unfortunately, that did not translate over to advertising. I think the economic distress hammered advertising. Probably the worst quarter I've ever seen in my career. I have to go probably pretty far back in the decades to find one that matches Q2 of 2020. If you look at just the annual forecast for Magna Global, ad spending is expected to sink 4% in 2020 after a record high in 2019. And again, that Q2 was could be down 17% in that one quarter alone. Now, if you look at 2021, it's interesting. We are perhaps back to that record high again. So that again is the snapback coming into play. Now, slide 15 shows core ad spending. So I stripped political out of these numbers to make it a bit more smooth and more related to GDP. As you can see, we expect, or Magna Global expects 2020 advertising to be down 6%, and then with a 5% rally back in 2021. And the year 2020 is really a tale of 4 quarters. The first quarter showed very nice growth along with the economy up 4%, and that was even with a March period that was reflective of the COVID-19 concerns. Then we're facing a Q2 shock period where advertising may be down as much as 17%. Again, one of the worst quarters I've ever seen. Q3, really hard to tell. Estimates are all over the map. We've seen some estimates much lower than this 5%. We've seen some back to flat. So Q3 is going to be certainly something to watch. Magna expects -5% and then back to stability in the fourth quarter. So that's where things at least stand today and probably what's priced into the market right now. Now, if you look at the next slide, you can see that there were a lot of categories that basically had to pull all their money out of the advertising market. These wouldn't surprise you. Travel, obviously, down 70%. Cruise lines and things that just had to completely stop service also pulled their advertising dollars. Auto unit sales also fell off a cliff. They have actually come back a bit better than we expected in April and into May. So there's hope that auto can make a nice turn, but was down 40% between March and April. And then entertainment, restaurants, and retail in the middle part of the graph, not surprising. If you looked at the far right, the ones that actually outperformed were the more durable consumer goods sectors like CPG, pharma, wellness, just given that people were at home and looking for ways to stay fit or eat healthy. You can see that, if you look back at our -6% Magna Global projection for 2020 on advertising, this is starkly different between linear advertising, traditional media, and digital. Linear could be down as much as 14% for the year, so not just for the quarter. And it's not really differentiating between mediums. So you have local television, national television, radio, outdoor, all down double digits. Digital is going to potentially grow, but that really is encompassing of, again, a shock period in the second quarter. And before COVID-19, we were seeing growth easily in the double digits. Now, one stat I want you to look at is the video plus 11%. We're going to focus a bit more on the evolution of video in a few minutes. That's going to show why companies are allocating more resources to digital video. If you look at slide 19, one bright spot is that political really hasn't been disrupted by COVID-19. Q2 is typically the lightest political spending quarter. We estimate 50% of political ad dollars are in the second half of the year. I'm sorry, 80% in the second half and 50% in the fourth quarter. Still expecting a record year, $3.5 billion on political ad spending. Political ad spending really is directly correlated with fundraising. And fundraising, even with a lot of wealth destruction in March and early April, it looks to be intact. And again, the market melt up has certainly has people feeling emboldened again. Now looking at the advertising exposure. So not all media companies are 100% advertising driven. They get a lot of money from subscription revenue. So your cable bills or paying Netflix directly. If you look to the far left, you can see Netflix is 100% subscription driven. So they're going to be a far better outperformer in this type of environment. As you move further to the right, you can see radio and outdoors, two of the sectors that are most impacted in this scenario don't really get much subscription money. Kind of in the middle, you have the cable networks and even local TV broadcasting with retransmission consent revenue. So that, the advertising shock is really impacting various sectors differently. Now let's move to the evolution of video. And I think this is an interesting look. Again, I think trends have accelerated from traditional into the digital world. And you can see here, these are projections actually on slide 22 from S&L Kagan. These are fairly new. And previously we'd seen traditional video customer losses of about 5 to 6% a year, and that excludes the virtual providers. So this is traditional cable, satellite, and telecom. And now the S&L Kagan forecast anticipates a 9% decline in traditional video customers. We're going to dig a little bit further into where are these customers going in just a couple of minutes. And as you can see on slide 23, the number of pay TV subscribers, again, declining at a more aggressive rate in the past 2 years. You can see on the far right where we have cord cutting labeled, you can see the progressively worse numbers as you move through time. Now, many households have been using subscription video on demand like Netflix as a complement, primarily because they have sports on their traditional bundle. But people are getting a lot more creative. They're using over the air to get their local NFL team. And the cost of the traditional video bundle continues to rise. And if you look at most surveys, the high cost of video is the #1 reason for cord cutting. The average price people pay is well over $50 a month. So if we are looking at a longer term economic distress picture, we could see cord cutting even worse than that -9%. The cost of programming continues to rise with retrans and sports. Sports has been the glue that's held the bundle together. We don't have sports right now. So it's going to be interesting to see when or if sports comes back. I know there's a lot of plans being thrown around out there, but I've yet to see a baseball game yet. People may look to leave the bundle, especially with that high cost and no sports. The value price proposition doesn't really make a lot of sense. Now, if you move to the next slide, you can see the virtual video bundle has helped offset some of those linear declines. You can see the far right, the leading virtual MVPDs. You have Hulu Live being the top, Sling TV, YouTube, etc. But even those services, because of the cost factor, again, are really starting to show slower growth. And again, with no sports, it's going to be a tough thing to defend. We've already seen one casualty, PlayStation View. So, it's going to be interesting to see if people will leave because of the high cost of these virtual providers. Not to mention the wealth of subscription video offerings that are now available to everyone at more reasonable prices, I would add. Now, looking at slide 25, let's look a little bit more at that subscription video on demand piece. You can see Netflix by far the leader. They were the first mover, close to 70 million subs in the US. Amazon is just an estimate based on the number of Prime members that watch video. And then Disney Plus, Apple have both entered the fray. They got a big head start. Disney has a relationship with Verizon, and then Apple has its iPhone situation where it can give the service to new customers on that front. So they were able to put the pedal to the metal in terms of subscriber growth. And I mentioned earlier that digital video is going to be a big focus for the media conglomerates. They've long feasted on subscription fees and cable. They're now having to get creative because they really risk leaving an entire generation behind, meaning millennials and people under the age of 35 that are consuming video in a much different way. You have Comcast looking at launching Peacock. They bought Xumo. AT&T with HBO Max, which just launched last month. Viacom has been throwing resources at Pluto. They also have CBS All Access, Disney with the Disney Plus and Hulu streaming services, and even AMC has been diversifying with Acorn and Shudder. That's two of just several streaming services that they own. And this is really where the world is tilting. And there's a saying that you skate to where the you ice skate to where the puck is going, and this is a perfect example of that. Now, another place that these video subscribers are going is over the air, old school digital antennas. And you can see the household growth expected growing at a 6% CAGR between now and 2024. And there's really two types of over-the-air homes. There's traditional over-the-air homes you might think around. They might live in a rural area, don't really have another option. They watch a lot of broadcast television. That's actually the minority of over-the-air homes now. Now you have younger generations, we call, in the industry, you call them stackers, that are stacking different services. So they have their broadband, then they have their over-the-air, and then they stack Netflix and Hulu and other SVOD services on top of each other to sort of build their own bundle. And that is really the growth area that we're seeing in the video space. So that's an interesting just evolution of video. And it's still early in the game to know where all this is headed, but I think the COVID-19 situation accelerated a lot of these trends, as I mentioned. Now let's look a little bit at some summer outlooks, and we're gonna dig a little bit more in the weeds by sector. So moving to slide 28, broadcast television has seen a bit of a renaissance with COVID-19. You need information on your local schools or the recent social unrest. You might want to know more about what's happening in your community. So local news ratings have actually been up 20 to 40% depending on the market. We haven't seen those kinds of ratings gains in years. That has really kept core advertising, the retrans outlook intact. So retrans is the fees that are paid from cable companies to broadcast television operators. And so that piece of the revenue stream should be quite visible for the most part. Now, they are not immune to the core advertising downturn. We do expect a 30 to 40% downtick in the second quarter. The good news is that this is spot television, so it can come back quickly given how closely to the air date that people place advertising orders. So some of the things we're going to be watching is economic activity in reopened states. Whether local news ratings are moving back towards normalized levels, monthly auto unit sales, because auto is a huge advertising category for local news. And again, those video cord cutting trends, to the extent retrans price increases can't offset some of those subscriber losses. And then we'll also be looking at political fundraising. A key year for local broadcast television. 60% of ad dollars go into local television coffers. So political is going to be key. You can see the equity performance on the bottom right. The stock market has not been kind to media companies and because of this advertising downturn. You can see the S&P 500 is down 3%. I think it actually may be a bit more down with the recent choppiness than this level. And you've seen stock prices down 30 to 40% year to date in the broadcast TV space. Now looking at national cable and broadcast, a bit more of a different outlook. Distribution revenue also should show some stability, but they are a bit more exposed to cord cutting than local broadcast TV. Ad revenue could also be down 30 to 50%, in the second quarter. The good news is, from recent presentations we heard over the past 2 weeks, is that June numbers are showing improvement from May. So that is encouraging that, as states reopen, things might be looking up. Now, national networks also distinguish very brightly between sports networks and non-sports networks. Sports networks obviously have no content to air right now, or no live game content, I should say. So there's been a bit more bias towards news and entertainment. So a company like Fox might be doing better with its news service versus say ESPN or the regional sports networks. And as I mentioned, a lot of companies are diversifying into direct-to-consumer. HBO Max has launched, Disney Plus. YouTube made up 15% of global video traffic. And so streaming is a big part of the growth area in terms of consumption. What we're watching, I think the return of sports is going to be key to most of the cable networks. Again, that's the glue that's holding that bundle together. Without sports, video cord cutting could definitely accelerate. And then if you have relaxation of stay-at-home measures, that could offer a lot more entertainment options away from just watching television in the home. And one last note on slide 29 is you can again see the equity performance of the cable network, similar to broadcast TV, being advertising driven, not having sports. You're down 25, 30, 40% year to date. The one exception is Netflix, up 44% year to date. And Netflix, you could argue, was perfectly positioned to capitalize on this situation. Now let's move to audio. I mentioned earlier that audio consumption is down. That there has been sequential monthly improvement in podcast listening. We've also heard that is improving slightly in May and June, but I don't think it's seeing the recovery perhaps that broadcast and cable TV has seen in terms of advertising. So we expect top line declines of 40 to 50% in the second quarter. We could, again, see a quick recovery given radio ads are placed in the spot market. But one thing we are watching is some of these dollars leaving traditional media going into digital during this time frame. The question we have is, are those dollars going to be permanent? Are they going to leave traditional media for good? And digital offers a lot of opportunity around targeting and data-oriented advertising solutions that traditional media has really struggled with. And we'll also be watching, again, auto unit sales for radio. A lot of that listening is in the car. And so, if we do see vehicle traffic start to perk up in summer months, that could be good for radio. On the bottom right, you can again see traditional media companies have underperformed the S&P 500 by a large amount. Sirius XM has fared better than broadcast radio. They don't have as much advertising exposure. And then you have Spotify, which has benefited nicely from the streaming consumption. And Spotify has also been leaning really into the podcast space. And there's a lot of euphoria about podcasts right now in the audio. Moving to outdoor, I'll just kind of focus on this quickly, but outdoor, we're watching that vehicle traffic again to see if people are going to be returning to public transportation. That's going to be key for the outdoor recovery. You can see on the top right, outdoor had actually seen a renaissance. So we were seeing 6, 7, 8% revenue growth in this sector before the COVID-19 situation hit. There's a belief, and I agree with it, that once things normalize, the outdoor will roar back to being a growth area again. But the question is when. It could take several months, if not a year or longer, to reach back to that point in time. Now, just some other media tidbits. Again, theaters, live events, and sports are just not happening. Again, sports may come back hopefully soon, so that should be good. But that's been a big hit on things like event sponsorship, pre-roll theater advertising, et cetera. And questionable what the future of theaters will look like now that people are used to buying some video on demand, new movies on demand at home now. There have been a number of movies that have been directly released to consumers. Now, the green lights show, social media and video games have actually been, on fire, really. You've seen active users up 20% or more for Twitter and Snapchat. Facebook has seen substantial growth. video games have just been, like I said, on fire. Nintendo Switch sales up 20% or more. Twitch, which is a video game streaming service owned by Amazon, has seen activity doubled from March. So that's an interesting statistic. And video gaming competes with leisure time for other areas, so it's definitely something to be aware of. Now, the last two sectors I'm going to focus on are a little different than traditional media. When I look at cable and telecom, cable first, that video cord cutting, a lot of people look at that as a risk to cable. We don't. We actually think that video is a low margin business. It's not a great business to be in. They're really more like a video retailer, and broadband is really where their bread is buttered. What are people doing more of? They're streaming more. So streaming means more broadband usage, which means more devices connected, which means you need higher speeds. Higher speeds cost more. And that's a very profitable endeavor for cable companies. Interestingly enough, because a lot of cable technicians are not going to the home, people are doing their own self-installs. So this situation has actually increased free cash flow for cable companies versus the pre-COVID-19 situation. Now, we're definitely going to be watching the streaming growth, economic activity, and the one area that's a bit of concern is small business for cable. Cable's been taking share from telecom for years in small business, and small businesses might have a bit of trouble paying the bills, given a lot of them had to close, and a lot of them live month to month in terms of their fixed charges. You can see the equity performance has been pretty positive for the most part. Comcast has gotten nicked up a little bit just because they do own NBC Universal. NBC is more of a media company, but cable's fared far better than traditional media. And one other point I was going to make on cable, if you look at the pie graph, video right now is 39% of traditional cable revenue. 5 years ago, it was almost 60%. So you can see that broadband and advertising and commercial takes up a much larger portion of cable revenue. That's much more profitable. Lastly, telecom, and I'll primarily focus on wireless. I think from a wireline perspective, what we're hearing is wireline companies are just investing in as much fiber optic lines as possible. And that's really the way, the strategic way forward for this sector. For wireless, the story is T-Mobile and Sprint. And that merger finally got approved on earlier this year. They closed on April 1st. So it's done, and now they can lean into 5G. And so that's where we're definitely going to be watching for wireless. We recently had a virtual 5G forum where tower companies, fiber companies, they were reporting that the activity has not slowed. There's been some slowdowns in municipal zoning and permitting, but the actual building of the networks is going as planned. And in fact, the COVID-19 situation has perhaps elevated the importance of bandwidth infrastructure and fiber optics and things of that nature. So I would argue telecom has been a winner, and as well as cable have been winners in the COVID-19 situation. Now I'm just going to wrap up with a final slide before we move to Q&A, and just to kind of end-cap it with some high-level thoughts. So the economy, again, one of the worst quarters we've seen on record in Q2, that's the bad news. The good news is that it's showing life, signs of life in states that have reopened. We have seen improvement month to month from April through June, especially on the advertising side. For companies in sectors that are more spot driven, you could see that advertising come back rather quickly. But the question is, have those dollars that have left traditional media, have they shifted to digital permanently? That's a question we're definitely going to be trying to answer over the next 12 months. I talked a lot about the video landscape. That shift is accelerating with the COVID-19 situation to subscription video and streaming in light of this pandemic. Direct to consumer models, I mentioned digital video, is growing like a weed. Traditional media companies are establishing these relationships, these direct relationships with consumers, and they see that as the way to the future, not to mention reaching younger people. And so you're going to see, I think, over time, more diversified business models. So not just relying on, cable subscriptions for revenue, but also on these direct-to-consumer models. And then the final 2 points, increased data consumption. I mentioned that with cable and telecom. As people are working from home more, they're streaming a lot more data. Kids are home from school and, they're on their devices as well. So that all that just leads to more bandwidth consumption. And then finally, again, that has really elevated, the data consumption has elevated the focus on communications infrastructure. So building the networks of the future in reaction to this bandwidth demand. That's the 5G area is not a 2020-21 story. It's a 2020 to 2030 story. So we're going to see just a massive investment in this space for a very long time. And with that, that concludes my prepared remarks. I appreciate everyone's attention. Look forward to Q&A.
Really covered a lot of ground there. You made so many good points. And I think our audience appreciated that as well, judging by the number of questions that we received here. So we're going to do some Q&A now, and we're going to start with a question from our good friend Gary Arlen. What lasting media changes will come from the COVID crisis?
Well, I think that people being at home has changed a lot about watching content, when you watch it, how you watch it, et cetera. And I think when you look at the larger media companies, and I suggested this in the presentation, is that they're all establishing direct relationships with the consumer. And streaming is certainly one way they're doing that. So I think with the new services like HBO Max being an example, it's really accelerating people to these direct-to-consumer platforms. It's also a way they can, if you look at a lot of the studios, Viacom, CBS owning Paramount, you have Universal Pictures with Comcast and Peacock, and then you have Disney Plus. They're going to be experimenting with direct-to-consumer film releases, and you've seen that a lot of films have been, very successful in this COVID-19 situation. I think Trolls World Tour, nothing that would really catch your eye under normal circumstances, had the biggest digital play in home for a movie in history. And then, the other question is working from home permanently. Is this a permanent situation? You've seen that a lot of the daytime programming has seen incredible ratings. A lot of the daytime streaming has been shown significant growth. So I think there's going to be a lot of focus for media companies on establishing those direct-to-consumer relationships. And I think it's happened far more quickly than anyone thought with COVID-19.
And what about the new habit of watching free video streams and the effect on old media?
Well, you have to monetize it somehow. And I think there is a limit in terms of what people are willing to pay, how many services they're willing to pay for, et cetera. So I think this is really a situation where you're reinventing advertising-driven television. If you look at most of the newer services, HBO Max seems to be more of a subscription-driven. The price point's a bit higher. But you look at something like Peacock, you look at what Viacom CBS is doing with Pluto, advertising video on demand, AVOD as we call it, I think is seeing a big growth phase right now. And so I think you're going to start to see a reinvention again of that advertising dependent television. I didn't even mention YouTube. YouTube is a major power player in the world of AVOD.
When it comes to the streaming services, do you have a sense of how much elasticity there is in terms of the number of services that the average consumer might be willing to pay for?
Well, I think the studies I've seen have shown that people tend to add between 3 and 5 services. And one slide I had on the presentation was around these stackers that they stack their own bundles or their own channels together along with over-the-air television. So I think that's a trend you're going to start to see more of. It's interesting when you look at the price points of some of these streaming services like Apple TV Plus and Disney Plus, they're very cheap price points. And I think, it's something that the media companies are experimenting with. And I think it's going to be a strategy that seasons over time. The other thing I would mention too is that I think the major media companies are concerned about missing on a direct consumer relationship with the younger generation. It's pretty clear when you look at the statistics of younger generations, adults under the age of 34, they're just not watching television the way older generations are. And so, they need to be moving aggressively, using those cheaper price points to establish those relationships. And the economics, I think, will evolve over time.
Okay, switching topics. What impact, if any, will the Black Lives Matter and social justice movement have on the media sector? For example, do you envision any corporate governance changes or responses?
Well, we've seen just an incredible response from the corporate community. I can speak firsthand at Wells Fargo. We've seen, our executive leadership team really support the diversity movement. It's really taking hold in the corporate world, and I think that's a good sign. And I think media companies have been right along, with companies like Wells Fargo in pursuing that. So I think, you're going to see, more diversity, more efforts to diversify leadership and, boards of directors, et cetera. In terms of the content, a lot of streaming services were putting together Black Lives Matter, suggestions in terms of watching content so that people could understand the situation a bit better. And so, it's possible that more content around themes similar to, social justice and things of that nature, will be created over time. So I think that's a positive sign.
Okay. Moving a bit to the tech sector, where do you see the money going that advertisers are pulling from Facebook in this boycott movement lately?
Yeah, very interesting. I don't cover Facebook, but I can tell you that most of the equity analysts have not really adjusted, their models substantially for any impact from these boycotts. So that either tells me that they're not pulling dollars that are that big, or they're viewing it as more of a temporary situation that maybe Facebook will adjust some things that will satisfy these advertisers to where it's just a blip on the radar screen. Where these dollars may go, one of the slides I had in there showed the growth of digital media. And I think one of the biggest growth areas in digital media, and we've already talked a lot about it, is digital video and these AVOD services that are able to monetize, the incredible content that's out there, but also able to monetize the data. And that's the value of Facebook, is it can target with laser pinpoint accuracy. And I think these digital video services that are advertising driven aim to do the same thing.
A related question, maybe with a longer time frame. How do you see the DOJ's antitrust investigations and possible actions focused on big tech impacting the analysis?
That's a big question, and I'll kind of sideswipe this a little bit just because I don't cover big tech, so I'm not as focused on how it might impact Google and Facebook. But I do think it sharpens the focus on this year's election. If you have a Democratic-led FCC, it tends to be more regulatory focused. And so that's going to be something to watch, I think, in terms of the election. How that impacts big tech and whether we're likely to see, more of a crackdown.
Okay. Coming back to traditional media, going to sports, if sports comes back but without fans, do you think that will be enough to remedy the situation, especially the cord cutting that's been happening because of the lack of sports?
Yeah, one thing I suggested in the presentation is that, if we are in a prolonged situation without sports, I do expect some accelerated cord cutting, because sports is really the highest cost in the video bundle. And I love baseball and I can't wait to see baseball, but I'm really not going to believe we're going to have baseball until I actually see a first pitch. There's a lot of headlines going on around COVID-19, players testing positive, things of that nature. So I'm not ready to get ahead of myself and say, when sports are going to happen and how they're going to happen. I do know that if they do, they're not going to have fans. I think that it's going to be good for television. I think for people that are starved for content, they're maybe growing weary of some of the programming that's out there right now. Having live sports is going to be a big draw for for consumers. So I think it potentially, again, if sports happen, could potentially slow the pace of cord cutting when that happens.
Okay. What's your view on AT&T divesting DirecTV and related issues as it reevaluates its Time Warner purchase?
Well, I don't really think AT&T is reevaluating its Time Warner purchase. Again, AT&T is another company I don't cover. I'm in high yield and high yield debt, and AT&T is an investment grade company. But we do watch AT&T just because they are an enormous company in the landscape of media. And we've seen the strategy with the Warner acquisition change quite a bit. We've seen the HBO Max strategy. They have retired some of the other brands. They've moved a bit more away from DirecTV. You've seen the cord cutting. AT&T's had probably by far the worst video subscriber losses we've seen in the industry. And so the DirecTV acquisition still generates a lot of cash for the company to continue to pay its dividend, et cetera. But I think most people that follow the industry, believe that Dish and DirecTV, could potentially look toward a merger down the road. It's been suggested by Charlie Ergen that it's a merger that's always made sense. In that case, I could envision, AT&T potentially spinning off DirecTV and merging it with Dish. And Dish and Charlie Ergen currently have wireless ambitions, and so that's it's possible Dish may look to divest itself of its satellite business at some point. There's a lot of questions about the regulatory environment, whether that would pass muster or not. We saw the troubles that Sprint and T-Mobile had getting through all the different legal hurdles. It took them almost 2 years. I think Dish and DirecTV would face similar hurdles because it does take out completely one competitor from the marketplace, especially in rural areas that don't have cable as an option. And so there would have to be some sort of conditions around that. But that's just the regulatory environment, not to mention price and who controls it, et cetera. So there's a lot of hoops to jump through to the extent we ever see consolidation between Dish and DirecTV. But I do think it's something AT&T would potentially look at down the road.
Okay. Well, thanks so much, Davis. I'm afraid we're running out of time, but we have a lot more questions that are waiting, but I'm afraid we'll have to stop here for today. And maybe we can have you back at some point in the future. But great presentation. Thanks so much for joining us and sharing your insights today.
Thank you, Rick. I appreciate everyone's attention. Thanks for having me, and I look forward to hopefully doing this again sometime in the future if everyone got something out of it. Thank you.
Great. And again, thank you to our sponsors for being with us here for our first virtual luncheon. And special thanks to Arlen Communications and LG Electronics for this production. And thank you for watching. And we'll see you on July 29th with FCC Commissioner Michael O'Reilly. So thank you for being with us today.
Thank you to our special guest speaker today. Thank you to the Navy Band. And thank you again to our sponsors. See you next month.